When COVID first struck and billions of people were forced into lockdowns, a US exercise bike maker saw its popularity surge. So too did Netflix, as many of us became couch potatoes and turned to Zoom for their social catch-ups. COVID-19 was a great time for any company that could loosely be considered a tech stock. In Australia, Afterpay shares surged by more than 1,000% at one stage from their low point in 2020. As central banks flooded the world with cheap money, investors were betting on companies that could become the next big thing, even if they didn't pay dividends or earn a profit.
With interest rates close to zero, you're not going to worry about putting your money in a term deposit because you're getting nothing. So why not invest in something that's got heaps of growth potential?
But lately, investors have fallen out of love with tech.
The Nasdaq comp within the last couple of seconds has now fallen 10%.
Tonight, Peloton's stock plunging.
Facebook's parent company has suffered its biggest stock slump in history.
Many investors have cashed out and put their money elsewhere. Shares in Peloton, which has yet to make a profit, have plunged, while Zoom, Netflix and Tesla have plummeted as some of the gloss has come off their rosy prospects. And Facebook, or Meta these days, is not as popular with younger users who are trying out other social media apps. Even the stocks that survived the tech wreck of 2000 have fallen despite making decent profits.
Other options become much more attractive than tech stocks when interest rates start going up. A lot of them are not making a profit yet, which means they're running on borrowed money, which is going to cost them a lot more in a higher interest rate environment.
The nation's biggest lender says the Reserve Bank could hike the cash rate as early as June. And the US Federal Reserve is expected to lift interest rates as much as 7 times this year to contain inflation. That's led to some big falls for Australian tech stocks as investors believe those shares are getting too pricey compared to what they're earning. Even Airtasker's boss Tim Fung believes the sector may be a little overvalued.
We did at Airtasker have an extremely good first few days as a publicly listed company, but I think that was obviously a little bit of over-exuberance. We don't really look at the share price, we're absolutely just focused on our long-term mission.
Like many young tech companies, Airtasker hasn't earned a profit yet, but its revenue is growing quickly, so he isn't too worried about rate hikes.
So I think that it's definitely going to put a slow down growth for companies that are investing into the future.
But it's a different story for privately owned startups. Craig Blair runs a venture capital fund called Airtree Ventures. Earlier this year, he was given $700 million by superannuation firms and wealthy individuals to invest their money in promising new businesses in return for a cut of their future success.
We're seeing tremendous opportunities around new platforms like machine learning and artificial intelligence.
Some of his investments include companies worth over $1 billion now, like Canva and Employment Hero.
We're taking long-term views, like we're thinking 8-10 years ahead.
But for the average investor thinking of buying the dip, that could be a risky strategy.
Tech stocks will be very much limited in their upside, and there may be quite a bit more downside for them.
Especially if they're not earning a profit when interest rates are on the rise.
And while the outlook for the tech sector is mixed, the metaverse economy is growing at pace. Global investment bank JP Morgan has opened a lounge in Decentraland this month, saying the metaverse will likely infiltrate every sector in the coming years. Norton Rose Fulbright's Nick Abrahams says people are making real money in and from the virtual world.
It's moved incredibly fast over the last year. So we're seeing gamers on play-to-earn platforms like Axie Infinity who are earning thousands of dollars a month. It may well be a way for parents to monetize kids' screen time as well. Also virtual land. So you mentioned JP Morgan in Decentraland. So virtual land sales hit $500 million last year. And we've also seen sports collectibles selling in the metaverse as non-fungible tokens and really having an enormous amount of value. So the US Basketball Association, the NBA, sold $700 million worth of short video clips as NFTs last year.
So, Nick, is the infrastructure for the metaverse built? Will this be part of the key to its success?
When we talk about the metaverse, the concept is it's the embodied internet. So it is moving from the two-dimensional internet into the three-dimensional internet. So where you'll actually experience it. So when you go shopping, rather than an online shopping right at the moment is sort of click and something goes into a virtual shopping cart. In the metaverse, it will feel like you are in a real shop and walking around with a shopping cart. So if we think of it that every interaction, the way we play, the way we shop, the way we work on the internet needs to be translated into a three-dimensional experience. So we have just barely scratched the surface of the infrastructure necessary.
So what sort of infrastructure is there? Are we talking headsets, or is it things that we haven't even thought of yet?
So there will be headsets. That's not critical. I mean, many of the metaverse lands, be it Decentraland or Sandbox or Somnium Space or even Facebook's metaverse land, can be experienced without additional technology. Then you've also got just the interface, building those interfaces. How do you take all of the existing experiences? For example, Walmart is going heavily into the metaverse. They will need to make your experience as you go through Walmart feel like you are actually inside a Walmart, but you'll be sitting at home in front of a screen.
So then how are companies preparing for the metaverse? How seriously are they taking it?
Companies are taking it very seriously. We've had over 75 of the world's biggest brands make significant inroads into the metaverse in the last 6 months. And so you look at organisations like McDonald's, we know that their plan is that you'll be in the metaverse and going around there, and you'll be able to order at a McDonald's and it will arrive to your doorstep. So that's that combination of digital and physical, which people are calling rather awkwardly the phygical. So I'm not sure if that will catch on, but that's the concept: is you change the way people interact. We've got Penfolds, who make a significant amount of their profits from the gifting of premium wine, but it's very hard to actually gift a bottle of wine because it's such a fragile object. And so they've had some great success selling digital NFTs of wine, which is redeemable for the actual bottle of wine, and you can trade that or gift it as you like.
Nick Abraham, it's been great to talk to you. Thank you so much for joining us.
Thanks very much, Catherine.